Hello, everyone. Happy Thursday. I just thought I'd make a quick video today about CMHC and some of the punitive changes that have occurred in the last, well, really in the last month or so. I'm in the middle of a refinance right now, and I'm having some serious heartburn with it. So I just want to share an update with you on the process of what I'm going through. So I'm just going to do this to Facebook Live. So just give me 2 seconds to queue that up. And just give me 2 seconds here. Alrighty. And away we go. Looks like it's working. So this has just been, a crazy experience of trying to do a refinance. CMHC they've literally moved the ball every possible chance they get. And, as investors, we've had to try and navigate. It's not going to let me do YouTube Live. So what has changed and why? Well, I'm going to first of all talk about the two types of multifamily projects that are really out there. So there's buy and hold, which is, kind of the typical way to do it. You buy a building that's already optimized. Income and expenses are fairly stable, may or may not be in top condition. And you get a long-term loan on it and financing through CMHC. So you hold that for 5-10 years so you pay it off. It's the solid way to go for sure. But there is sometimes a more attractive option, and sometimes it's the only option. If a building is like you have a lot of vacancy, the rent's really low, maybe it needs a lot of work, then we can consider the B.R.R.R.R method, which stands for buy, renovate, rent, refinance, repeat. So this strategy, or the value add strategy, this has been around a long time. I was doing this 20 years ago successfully. I've successfully executed, 4 or 5 of these strategies, B.R.R.R.R strategies on my own. And it can be a great way to get a lot of equity quickly, because in the past you could, increase value quickly, pull your equity out and refinance into another project. And you could literally just keep recycling your cash over and over again. Well, unfortunately, most of the time people were doing that with CMHC. And recently, CMHC has really not like that. They've really been favoring new construction. So I want to just talk about what's happening with CMHC and how a lot of investors like us were really caught off guard by these punitive measures that I don't agree with. But unfortunately, this is the territory we live in. So I want to talk about a few options that we have as investors. But first of all, I just want to run through the changes and kind of my thoughts on that. Okay, so I'm just going to do a quick screen share here. Bear with me. Da, 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 da. Okay, so what punitive changes has CMHC done? So I'm just going to do a brief overview and a brief history since I've been following this. Now, I talk to lenders, appraisers, other investors, realtors, on almost a daily basis. And I did a lot of research for a webinar that I'm doing in exactly 2 weeks today. So hopefully I see as many of you as I can on that. But I'm just kind of giving you a bit of a sneak peek of what you can expect on that webinar. But this is critical information if you already own a multi, if you're considering investing in one. A lot of investors, there's so many rule changes, it's crazy. So if you're not, almost talking to a mortgage broker on a daily basis, you might miss something. So again, this is my opinion only. This is my view from the cheap seats, my 2 cents. Disagree or agree, please comment in the chat accordingly. But this is how I see it. So I don't pull any punches. So I'm just going to share with you. Okay, so the first thing that they did, this was around the pandemic time. They decided to restrict the refinancing proceeds. So in the past, when I was doing the B.R.R.R.R strategy back in 2004, 2005, 2006, when rents were going up really quickly, vacancy was low, CMHC didn't really care. You could easily pull out, $500,000 and go buy a yacht. You could do with it whatever you wanted. There was really no restrictions on it. If you had a good bank or a mortgage broker, and you were able to keep finding projects, it was a really good time for investors. And it was also a good time for supplying a lot of good quality housing. Because in the markets that I'm in, there is no rent control. So I mean, you can only charge as much as the market will bear. So it was a great way to provide, safe and affordable housing for tenants, and also, make good money as an investor. Because a BRRRR project is not easy. It takes a lot of time and effort and money, and there's risk involved. So, so they began to restrict the funds. They didn't want investors to be using CMHC as a piggy bank. So they spelled it out and said, okay, you can no longer pay yourself. You can't pay out your investors. You can only pay existing debt. So if there's a VTB, if there's seller financing, a private loan, or another bank, and renovations, etc. You can only use your funds for those purposes. So you could use the funds to do renovations on your project, or you could use it to buy a new project. So a lot of people that were doing the BRRRR strategy to do the repeat and keep going, this was fine. It was only affecting the people that wanted to take their money out and spend it. So in November, so they made another change. Now they started to ask for appraisals. Now, CMHC never used to do that because, they have a really strong in-house team, strong underwriting team. They know each one of these markets. Even small town Manitoba, Saskatchewan, you can get CMHC loans, right? Conventional lenders won't touch those areas. So CMHC has a lot of underwriters to do this. But during COVID, they weren't visiting buildings. In the past, a CMHC rep would visit the building. You would pay for that, of course, but they decided to stop doing that. So they stated reason was the pandemic, but I think there was a cost savings there as well. They would do these mini appraisals in-house, but they wouldn't actually visit the property. So that has now changed. So they're actually using third-party AACI-approved appraisals, which that in itself wasn't that big of a change. Segue into 2021. So housing really started to become political, around the last federal election. So shortly before the election, no one knew the outcome, but Jagmeet Singh came in and said, he was against, CMHC, investors using CMHC to profiteer. Their, socialist ideologies, they're big union supporters, nothing wrong with that, but they don't like profit, they don't like entrepreneurs. That's a simple fact. So he was quoted as saying his party would impose strict rules on Canadian housing and mortgage corporation loans, CMHC, in an effort to stop so-called rent evictions. For-profit companies, he said, have been taking advantage of loans from the Federal Housing Agency to purchase buildings, renovate them, jack up the rent, forcing those who can't afford the new rates to find somewhere else to live. So he was quoted as saying this shortly before the election in 2021. Now, there was a lot of unscrupulous operators taking advantage of this. I'm not really going to comment too much in rent-controlled areas. I know there are some ways you can increase rents that are kind of legal, but maybe not ethical. For the sake of this conversation, we're not going to talk about that. But the NDP made this clear very early. They were going to put a stop to this, okay? So we all know what happened. The NDP got elected. They entered into a supply and confidence agreement with the Liberal Party, essentially holding the balance of power. So they have a lot of say in these decisions. And I strongly believe that, the NDP has played a very pivotal role, in the punitive measures that CMHC has imposed on multifamily investors. So around February of 2022, MLI Select rolls out. Now, this was an affordable housing initiative. It wasn't designed for people to do the BRRRR project, although that is exactly what it was used for. Suddenly, CMHC premiums dropped from 4.5% to 1%. You could do a 1.1 debt cover, 95% loan to value, 50-year AM. You could borrow just tons of money, and it was just basically like investors won the lottery. And literally, everybody jumped into this. Everybody jumped on board, except for a few of us. I just completed a BRRRR that year, so this was in the summer of 2022. I didn't go by my last select because I thought, we have $400 plus of rental upside in Alberta, and I didn't want to impose myself in rent control. So that was the trade-off, right? They're going to give you this money, but there was strings attached to them, and there was big strings. Now, the biggest string, of course, is the rent control factor. So meanwhile, your expenses are going up, but you can't raise rents. But, investors saw the cheap financing. Everybody dove in. You know, even mortgage people that were against this program from the start, they actually embraced it later because none of their clients wanted conventional financing or standard CMHC. So they basically did MLI Select or they were out of business. So with this one step, Canada Mortgage, CMHC, the Canada Mortgage and Housing Corporation, basically took a grip on the lending of the entire country for multifamily. And they took on like crazy amounts of loans. People were abandoning conventional. So many people jumped on board with this that CMHC was able to basically obtain a monopoly, an oligarchy on the entire multifamily lending universe. So, and a lot of investors, they based their exit strategy or even their only strategy was MLI Select. So, remove CMHC, they couldn't complete their BRRR, the deal didn't make sense. So I'm going to segue into that a little bit later. But that is what happened. So everybody dove in on this program that was supposedly almost too good to be true. Excuse me. So go fast forward to June of this year. So there was a premium increase announcement. So they increased the premiums from 1% to 2.55 for MLI Select, which is kind of the equivalent of, imposing a tax hike without actually calling it a tax hike. Okay, so this was, for anyone who was using this affordable program, now your premiums have gone up. But the hidden one that they didn't really advertise was the standard CMHC that, we had used for decades. They raised the premiums on that as well. So, from 85% loan to value, 4.5 premium, they upped it to 5.35. So, you add up all your fees and amortization premiums, you're close to 7% with CMHC now, 6.5. So they made it a lot more difficult, but you were still incentivized to go with MLI Select. Okay, now go to August of this year. Now they really start to put the vice on investors. So a lot of people go out and they have these BRRRR projects, they're mid-renovation. They went to these bridge loan companies like Harbor, got 1-year interest only loans, some really high interest rates, rates were starting to come up at that time. So, it's a risky business, right? You have to pay the loan back within a year or your rate goes up. You have to pay down equity, etc. So there's big risk involved in these BRRRRs. So at the same time, they decided to restrict financing to new purchases only, or you have to have existing debt with an approved lender. So what is an approved lender? So CMHC basically had a list of, banks they were friendly with and ones that they weren't. There was a lot of companies that, why aren't they on there? But they're not. Like Harbor, for example. So anyone who was doing a BRRRR with Harbor had a mortgage was suddenly out of luck, right? So now they're scrambling and now they have to find some other way to bridge onto an approved lender before going on to CMHC. So some banks, like People's Trust, for example, they decided to offer an in-house bridge product. They made it more attractive than you could get from market to get your financing through them. So, prime plus a few points plus a 0.5 point fee. And they would hold that for a year until you could get your MLI Select. Because the other thing that happened in June when they announced that is it just a flood of applications. Like literally anyone who was considering doing it did it. And it delayed deals up to 8 months. I mean, I lost the deal because of it. We submitted our CMHC application in May, and by September we still didn't have it. And we lost the deal. So that one happened, restricted to approved lenders only. So that one caught a lot of people off guard. Now the last one that not a lot of people know about yet, this was only on September the 13th. CMHC didn't go far enough. So they decided now, not only does it have to be an approved lender, you have to have existing debt with that lender for 24 months. Interesting. So basically you can do a purchase, but now you have to be, if you were doing any kind of a bridge loan, or even a VTB. So they even excluded VTBs from this. There's a bit of a debate on that, whether seller financing you can get CMHC from seller financing, but the general consensus is no, you can't. So this latest one now basically says you are forced, if you're mid-project, you have to go to some kind of conventional lender, or, well, basically that's it, like some kind of conventional lender that's on their list, because these bridge companies, they don't do 24-month loans. You can't get a 24-month interest-only loan. Now, I'm sure there's some hybrid products right now being created, but for right now, anybody who's mid-BRRR is like, wow. And I can tell you, I have seen so many projects hitting the market in the last 2 weeks, and it is just insane. Like the market is almost being flooded with product. So I have some thoughts about CMHC I'm going to share at the end, but this is a huge one. So basically, they have effectively banned BRRR projects in Canada. There's literally almost no way around this, right? You're either buying it with a 5-year hold, you know, or you're buying it for new construction. So, you know, the days of doing the BRRR with CMHC are effectively toast. Now, having said that, there are a lot of times when it makes sense, right? They've slammed the door. They don't like the word rent eviction, so they don't want to have anything to do with investors in older buildings raising rent. You know, they really are steering this in the direction of new construction. In fact, I would not be surprised if CMHC effectively bans MLI Select from any older legacy product, you know, within 6 months to a year. I really believe that. I think that's the next step. So as investors, this is something that we really need to keep an eye on, especially if we're planning to use CMHC. There is one MLI Select strategy that I would recommend. For the sake of time, I'm not going to go into this now. I'm going to talk about this during the webinar on the 24th. So again, I'm going to put in a link. So please register for the webinar. I have just a few seats left, but you're not going to want to miss this one. But there is definitely one strategy that I would consider. And again, as I mentioned, if your exit strategy depended on CMHC, you need to run. You need to find a better deal. You know, you buy a building, it has to make sense either doing some other form of financing, whether it's a VTB or a creative or conventional financing. If your only possible exit strategy is MLI Select, it is not a good deal. And based on the history of CMHC, I think they're just going to keep piling on these measures until they remove this program altogether. You know, so maybe even CMHC. So this is a huge risk to your business. So I think everyone needs to be aware of this. But there are also situations that CMHC does work very well. Okay, and I'm going to talk about those on the 24th as well. So again, join me on November the 23rd. I'm going to talk all about underwriting and more. I'm just going to give you a brief overview of what I'm going to be talking about. So I'm going to actually be showing you the tools that lenders actually use. So I'm going to be emailing everybody the exact spreadsheets and how they underwrite, how they look at it from their perspective. And this has really changed in the last year. So this is something, if you're planning to do a multifamily deal, you're going to find this of great interest. A lot of changes. I mean, I've only just scratched the surface on a few of them with CMHC. There is major changes. I want to talk about how appraisers, how they get their valuations. You know, I talked to several appraisers in doing my research, and there's a lot I didn't know about how they do their valuations. So this is interesting as well. Property manager, this is definitely the strongest one, their valuations, because they really have the most accurate and realistic expenses. So their underwriting, the way they underwrite is really valuable too, and I'm going to go through that. I'm going to touch on, you know, vendor takebacks and agreements for sale, you know, where they work today and where they don't, you know, in my opinion. And I'm going to show you some tools. I'm going to show you some quick filters to basically eliminate 90% of listings. I'm going to show you, how do you know if a buy and hold makes sense, or how do you know if a BRRRR makes sense? So there's definitely certain criteria to each. So I'm going to go through some very quick ways that it's going to save you a lot of time in your search. And I'm going to basically share with you what I'm doing. You know, so I'm going to say what I'm doing going into 2024, what's working, and yeah. My general thoughts on CMHC, it's been kind of a necessary evil. But again, it does have its place. But the fact remains is they're an oligarchy. They are a monopoly with no competition. And you are completely at their mercy. if you're buying a deal, you're refinancing, you're completely at the mercy of their timelines. You're at the mercy of their underwriting. You could be getting an underwriter in, Quebec who's underwriting a deal in Regina, and what they say goes. I mean, they have a lot of discretion. So you're literally at the mercy of them. So it's very important to have backup strategies, backup plans, and the amount of deals that CMHC worked good on in the past don't apply today. There are certain circumstances that do, but I'm going to talk all about this on underwriting. I'm going to show you what method that I'm using going forward, and it's not CMHC. So I went a little bit longer than I thought, but I hope you guys enjoyed the video today. Please register. I'll see as many of you as I can on the 23rd, and bring lots of questions about anything you want to know about underwriting multifamily. There's tons of good deals coming up right now. So those of us that know how to properly underwrite deals are going to be able to scoop up a lot of deals left, right, and center, because there's a lot of really good things happening here, in the next couple of years. So I'm very excited to get more property, and I'm very excited to show you guys what I'm doing as well. So thank you all for your support, and we'll see you on the 23rd.